You're scrolling through Zillow on a Saturday morning, coffee in hand, and you see it, a cute starter home, listed at $500,000. 3 bedrooms, 2 baths, 1,200 square feet of pure stress waiting to happen. You do a double take and realize your gross income is $84,000, which means this house costs 6 times what you earn in a year. 6 times. You're already picturing the mortgage, the taxes, the insurance, the maintenance. For $1,000 a month just to live there comfortably? Spoiler alert, that number doesn't even include the hidden fees that will crush your budget. And most of the people selling you this dream, they're lying. Hey, I'm Brian. I spend way too much time thinking about what everyone tells you about buying a home versus what actually works if you want to build real wealth without living paycheck to paycheck. And here's the thing. Experts hate that I'm about to show you this because it exposes the giant gap between qualifying for a mortgage and actually being able to afford a home without crippling stress. Today, we're going to break it all down. The math, the reality, the hidden costs, and why the system is stacked against you. We're going line by line on what it actually takes to afford a $500,000 house. And trust me, most people will fail this test. If you want truth over hype, hit subscribe and like this video. Let's stop buying into the dream and start seeing the numbers. So let's be real for a second. The median household income in the US is $84,000. That's what most people are bringing home before taxes. And yet, in many markets, the starter home everyone's pushing is $500,000. That's 6 times your annual income. 6 times. Let me say that again. 6 times your salary. Nobody tells you that. And the down payment? Traditional advice says 20%, $100,000. At median income, if you somehow manage to save 10% of your paycheck each year, which is ambitious, you're looking at 12 years just to save that down payment. 12 years. And most people don't do that. They put down 5 to 10%, triggering private mortgage insurance, or PMI, which adds another $200 to $400 to your monthly payment. Surprise. Now let's talk monthly costs. A $500,000 house with only 10% down already puts your mortgage around $2,850 per month. Add property taxes at $500, insurance around $300, maintenance at $417, and PMI of $300. That's a total of roughly $4,367 a month just to exist in your dream home. If that sounds insane to you, congratulations. You're paying attention. The problem isn't just that housing is expensive, it's that the system is designed to sell you a number you qualify for, not a number you can actually afford. Banks, realtors, developers, they all benefit from convincing you that this is reasonable. But here's the truth nobody says out loud. Most people buying a $500,000 home are setting themselves up for stress, trade-offs, and financial vulnerability. All right, here's where it gets really fun. Let's break down that $500,000 house line by line. Because if you skip even one of these numbers, your affordable home is actually a financial trap. Step 1. The mortgage. With a 10% down payment, $50,000. You're borrowing $450,000. At a 6% interest rate over 30 years, that's about $2,850 per month. That's just the base. Step 2. Property taxes. Depending on your state, these can vary wildly, but a conservative estimate for a $500,000 home is $500 per month. Some areas are higher, some lower. Still added in. Step 3. Homeowners insurance. Another $300 per month is standard. Flood insurance, liability coverage. This is non-negotiable. Step 4. Maintenance. Rule of thumb is 1% of the home's value per year. For $500,000, that's $5,000 annually, or roughly $417 per month. Roofs, plumbing, lawn care, paint. These bills don't ask if you're ready. Step 5. PMI, private mortgage insurance. Because you didn't put 20% down, add $300 per month. This protects the lender, not you. Total monthly cost, $2,850 plus $500 plus $300 plus $417 plus $300 equals $4,367. Now, let's reverse engineer what you actually need to earn. The traditional 28% of gross income on housing rule says your housing should be no more than 28% of your pre-tax income. So divide $4,367 by 0.28, and boom, you need about $187,000 per year. Even if we loosen the rules with the 43% debt-to-income ratio lenders sometimes use, you still need about $150,000 per year. Let me say that again, $150,000 at a minimum, just to survive in this $500,000 house without cutting food or skipping car insurance. Here's the cruel reality. Only 10 to 20% of U.S. households earn that much, meaning 80 to 90% of people cannot responsibly afford this house. Yet somehow, the industry keeps selling this as starter home material. And remember, this doesn't even include your car payments, groceries, student loans, utilities, or any lifestyle expenses. The math is already stacked against you. If you're feeling a little queasy at this point, that's intentional. Congratulations, you just unlocked the uncomfortable truth about affordable homes. Most people don't want to face this, because if the math sinks in, the whole system of selling homes above what people can afford collapses like a house of cards. If you're new here and just subscribed, comment your name below. I read every comment and shout out new subscribers in my next video. I do appreciate you joining me on this finance journey. Here's the devastating truth. Only about 10 to 20% of U.S. households earn enough to actually afford a $500,000 home without stretching themselves into financial desperation. Let me say that again. 80 to 90% of people are trying to fit a $4,300 plus monthly payment into budgets that can't handle it. This isn't an opinion. This is just math being cruel. No clever hacks, no side hustles. No, you just need discipline. The numbers don't lie. The system is stacked, and most people are swimming in a pool they can't afford while being told it's normal. Congratulations, you just unlocked the truth that nobody wants to admit. Let's make this real. Meet the Johnsons. They earn $160,000 per year, well above the national median. They're successful by most standards, but even with that income, they struggle to make a $500,000 home work. Take-home pay after taxes? Roughly $9,500 per month. Let's break down their actual monthly spending. Mortgage, taxes, insurance, PMI, maintenance. For $1,367, 46% of take-home pay. 2 cars plus insurance, $1,200. Groceries, $800. Utilities and internet, $500. Student loans and credit card minimums, $1,200. That leaves them with $1,533 per month for everything else: clothes, health emergencies, gas, dining, vacations, hobbies. One unexpected event, a broken HVAC, a car accident, or a medical bill, and they're instantly scrambling. Scenario 1. Their furnace dies in February. Replacement cost, $6,000. That's 4 months of discretionary income gone. Scenario 2. Their oldest car's transmission fails. $3,500 repair. They have to put it on a credit card, adding interest payments. Scenario 3. Their daughter needs braces. $5,000 of pocket. Emergency savings? Barely covers one of these expenses. Scenario 4. Annual property tax increase of $300 per month. Suddenly, the budget is tighter, the discretionary buffer evaporates, stress skyrockets. Emotionally, it feels like walking on a tightrope over a pit of fire. Every month is a balancing act. Pay the mortgage, feed the family, avoid debt traps. There's no flexibility, no breathing room, no financial freedom, just constant calculation and anxiety. Even at $160,000 per year, the Johnsons are house poor. They're the classic example of people doing everything right: good credit, decent income, steady jobs. Yet the system is still squeezing them dry. This is what the statistics don't always show. Affordability is not just a number. It's about real-life stress, sacrifices, and vulnerability. And the real kicker? Most financial advisors will still tell them, you can afford it. You just qualify for the mortgage. Qualify, yes. Afford comfortably? Absolutely not. Here's the uncomfortable part nobody tells you. The system is designed to push people into homes they can't afford. Realtors make money on the sale, lenders make money on bigger mortgages, and developers make money by building higher-priced homes. Everyone profits while buyers stress over numbers they barely understand. Banks will pre-qualify you for a mortgage of $500,000, $550,000, even $600,000, and then tell you it's safe. Safe. Only if you ignore groceries, car repairs, and emergencies. And yet, people still buy because social pressure says, you're adulting, you need a home, it's now or never. The truth is, the incentives are perverse. The system benefits from buyers overextending. It doesn't care about your financial freedom. It cares about selling the house, the loan, the insurance, and the PMI. People fall into the trap because they trust the process and assume qualifying equals affording. So yes, the market is broken, but it also feels normal because everyone is doing it. You see neighbors, friends, colleagues struggling, and you tell yourself, if they can do it, I can do it. That's exactly what the system wants. Here's the brutal reality. The math doesn't work. Median incomes haven't kept pace with housing prices. Since 1990, home prices have increased roughly 400%, while median household income rose only 180%. Let me say that again. Prices doubled faster than wages. The classic advice, save harder, work more, hustle side jobs, doesn't close the gap. It cannot. The numbers are bigger than effort. You can't outgrind systemic inflation and market manipulation. The system isn't broken because people fail. It's broken by design. And if you buy into the fantasy that your success will make it easier, the math will crush you anyway. So what does this mean for you practically? Let's be direct. If you're looking at $500,000 homes and your household income is under $150,000, you are not financially positioned to buy without stress. That's just the numbers. Step 1. Stop pretending you can afford what you qualify for. Forget the bank pre-approval. Your focus should be what leaves you room to breathe, save, and handle emergencies. Step 2. Calculate your safe housing budget, 28% of gross income max, and check your actual leftover cash after all other expenses. If the math is tight, wait, rent, or buy smaller. Scaling down isn't failure, it's strategy. Step 3. Understand the month-by-month deterioration if you ignore the numbers. One emergency, car, HVAC, medical, can wipe out your buffer and force debt. That's house poor in action, sacrificing freedom and stability for a property you can barely manage. Here's the permission part. You are allowed to opt out. Renting or waiting isn't weakness, it's patience. You're not failing. You're strategically avoiding a financial trap. Focus on wealth building instead of house hunting. Build cash, invest, and buy when it genuinely makes sense, without stress or compromise.